Mas hoje acredito que sou brasileiro porque se diz homem é o que ele como. Eu sou como culinária brasileira. Sinto-me honrado por estar aqui. That's the limit of my Portuguese. Oh, so I have to put it here. Okay. Obrigado. So let me chat a little bit. I know that you've had some sessions already talking about. Oh, okay, yeah, okay. So I'll hold it. Yeah. Is that better? Perfect. Okay. I know that you've had some sessions already talking about investments in energy infrastructure for resilience, especially for the community. And I know that in the last few sessions there were many questions about how to finance these investments, and that's an important topic. The nature of investments is always, finance is always a major problem because with infrastructure investment, you have to get the cash flow up front and then you receive benefits over a long period of time. And that means that, that finance is a major obstacle to address. So that's what I want to talk to you about today. Let's see if I can get this to switch, maybe not. Yeah, I am pressing the green. Maybe I have to turn it, the big green. Ah, there we go. And okay, so let me just tell you a little bit about what I'll speak about. Generally, I'll talk a little bit about the kinds of innovations that I've seen investing in infrastructure, both in the US and a little bit in Brazil and in Latin America. I'm very happy to hear your questions afterwards, especially about the Brazilian context, about which I don't know very much, but happy to translate what I've seen elsewhere in Latin America and of course in the US. Okay, so I think one of the things that we have to understand about our time today is that if you looked back between 1990 and 2020, so 30-year period, it was a very different period in terms of finance and the valuations placed on things like the environment, natural capital, human capital, and we've sort of shifted from that period since 2020. And that shift has changed the way financing is done. It's important when you are thinking about how to finance these types of investments to keep that shift in place. So for example, globally, between 1990 and 2020, we saw significant drops in interest rates. And so in many ways, it got easier to finance long-term projects. Since 2020, that has changed. So it means that we have to be much more careful. But at the same time, there is much more capital available, much more financial capital available. There is a recognition that there's a scarcity of material resources, a scarcity of oil, there's scarcity of natural ecosystems, scarcity of food. And in the past, we saw that asset valuations relative to the cash flows also rose a lot. Between 1990 and 2015 or so, the ratio of world asset value to world GDP went from 6.5 times to 10 times. That's a very significant, it's sort of almost a 50% increase in asset valuations relative to cash flows. But now we're starting to see that change as well. So it's important to keep that in mind. It means that when you try to finance the kinds of investments that don't easily convert into cash flow, you have to be much more careful. There is another trend that we've seen over the last 15 years or so, which is the interest in what's called sustainable investing. And it has many names: responsible investing, ESG investing, investing for the Sustainable Development Goals, the SDGs. And all of these types of investing recognize that there is a need to look beyond just the financial return of an investment. So, for example, we see quite commonly that an investor will say, not only do I want this project to have a good financial return, but I want to know that it is adding value to its stakeholders. Why? Because if it's adding value to its stakeholders, then I can be sure that it will have a license to operate, that the customers are benefiting from it, so they have an incentive to pay for the service they're receiving. So you'll have fewer non-payment problems. It needs to be an activity that the employees benefit from. For example, it's an activity that the employees expect to be able to develop their careers in. There is actually a shortage of young, skilled people. Many employers throughout the world talk about the shortage. And it is much easier for a company to attract young, skilled people to work for them if it's a company that's known to be sustainable. This is a well-documented trend. Those employees will have longer staying power. There'll be lower employee turnover. The training costs will be lower. Paying attention to corporate governance, for example. Companies that bring in a diversity of views into top management, into the corporate board, into senior management. That means having women on the board, having women in senior management, having access to viewpoints that will allow them to operate in different markets, are sources of resilience for a company. In a time where you have greater uncertainty, I know that yesterday Walter was showing you some of the impacts of climate change in Uruguay, for example, and there's much greater variability in rainfall, in temperature, and that means that investments, the institutional setup has to change and has to be resilient. And in that situation, you're always better prepared if you have a diversity of approaches. And this is a quote that is very important for this idea, which is that, the US, Brazil, they're in many ways decentralized economies. And with a decentralized economy, one of the virtues is that decision-making is spread out across different types of people. In Brazil, there are many states, many provinces. Of course, Brazil has many different ecosystems, and what is appropriate for the Amazon is not what's appropriate for Sao Paulo, and so on. That's a virtue to have that decentralized approach, but if that virtue of a decentralized economy is that it diffuses decision-making across many different types of people throughout the system. That virtue becomes meaningless if the people with power are all alike, or they become alike through imitation. You know, it's very common for people to say, oh, such and such company is powerful, rich, it's a big conglomerate. And how did they become a big conglomerate? Because they were, they paid attention only to profit. They paid the lowest wages, they charged the highest prices, they negotiated the best possible input prices with their vendors. And so, even if you don't want to think like that, there is a pressure to imitate that kind of behavior. Okay? But that won't. That's a false. That's a false sort of approach to take, because the environment changes all the time, and in a world where young people are hard to find to work, or in a world where interest rates are high so that you have to find other forms of financing, or in a world where you will face problems with financing or with your business, if the communities that you operate in are receiving value from it, they will work with you to try to keep it going. And if you're in the business of energy and providing energy access, especially to a broad range of communities, low-income communities in particular, then if you have a service that generates value for them, they will make it work. It's in their interest to make it work. And so I think that's sort of, if I had to boil down my presentation today into one slide, this is the slide. It may seem far away from the details of what we'll talk about in a moment, but that's the important thing. You want to have that variety. Now, I'm sure you've heard that the climate finance flows that the world is seeing currently are very low compared to the needs. Based on the UN's assessment of what is needed for adaptation finance, especially in the most vulnerable countries, which are all developing countries, emerging markets, based on the assessment of need, the actual flows that we see are very low. And it's unlikely that they will ramp up anytime soon. And these are the official flows, so flows, government-to-government flows, for example, or what the multilateral development banks or the bilateral development banks tag as climate finance. Though they're in the order of about 100 billion a year. But what we need is more like in the order of trillions, right? And one thing that's important to understand is that the private flows are much larger, but not tracked. And of course, there are private flows through what we call foreign direct investment. That's a part of what Enel is involved with. But the private flows through remittances are very large as well. So remittances are workers, Brazilian workers working in the US, in the EU, not necessarily working in great jobs, but sending back a significant portion of their earnings. So remittances are as large a set of flows to developing countries and probably larger than official development finance, but it's just not tracked as well. So let's talk a little bit about, why is financing a challenge? Let's say you have an economic activity that you want to carry out. You want to build some coastal infrastructure. Let's say that you want to invest in a mangrove restoration project. That's going to have huge local co-benefits for carbon sequestration, for coastal protection, but it is very difficult to finance that type of project. Why is that? Well, here I've laid out a 2x2 matrix. There are two types of things we finance. We generally either finance assets or people. Financing assets tends to be relatively easy because there's something physical there, and the lender or the financier knows that the use of proceeds, the money is being used to buy some physical asset, and it gives the lender or financier comfort that there is some value there. If for some reason, because of illiquidity, bankruptcy, there will be an asset. In an ideal world, that asset will have a value that's commonly recognized. And so in the top left corner of that 2x2 matrix, I've got an example of, say, a toll road or a community solar generation projects. Both of these are assets that are being financed, and the value of those assets are widely accepted. The toll road is used by lots of people. Everyone's paying a small amount to use it. So I don't have to worry about just a few concentrated users. On the other hand, there are businesses where I have to finance people. And software development is an example of a business where I have to finance people, but still the market value is relatively widely accepted. Software is harder to finance than community solar, because now with software I do have an asset, but it becomes much harder to evaluate whether that asset is truly useful. It's very easy for software to lose its value if somebody else writes better software. And in any case, if I want to know if it's valuable or not, I have to test it, I have to look at the code, and that takes time. So the verification process takes time and money, as you pointed out, right? So those are still relatively easy. The kinds of projects we really want to finance are things like irrigation infrastructure, coastal protection, the Amazon bioeconomy. These are major initiatives in Brazil and in Latin America. And not only are we talking about sometimes people, but we're also talking about things where the value is relatively uncertain. And why is the value uncertain? You know, irrigation infrastructure, usually it's very clear who benefits. There will be some farmers who will benefit from resilience from drought or from flooding, coastal protection. The people benefiting, they have low formal income, maybe even no formal income. And therefore, they do have a willingness to pay for those assets, but it's harder to put a dollar value on it or reais value on it, right? And so that's the hard work that often needs to happen. So when you think about trying to finance community infrastructure projects, and probably energy is the easiest of them, you have to think about how do I get that energy infrastructure to be utilized by low-income communities in such a way that they can generate income from it. So you can't just say, I'm going to, here's a segment of the population, they don't have easy access to electricity. So I'm going to come up with a distributed solar grid, and that will provide them with electricity. Because they will need to pay for that electricity. And they're not going to want to utilize the electricity and pay for it unless they can utilize the electricity to generate formal income, which is what they will use to pay for the bill. And the cost-benefit analysis for electricity and water is generally what we call a no-brainer. Any investment in energy access, in water, clean water provision, usually the willingness to pay for it is 10 times that investment. I mean, just to give you an example, I grew up in Zambia and Zimbabwe, in sub-Saharan Africa, and there are parts of Zimbabwe far away from the urban areas where it would be common for a woman to spend 1/3 of her day walking somewhere to get clean water, maybe from a truck, maybe from a well. But so if you think, okay, here's a person who's spending 1/3 of their time getting clean water, that means if you were evaluating their time in dollars, they're willing to spend 30% of their income. Yeah, so any place, you can be dirt poor, but you're still willing to pay 30% of your income for clean water. And electricity is a bit lower than that, but not much lower. So the cost-benefit analysis is usually a no-brainer. However, we need to do the hard work of translating that electricity and water into the units, the currency in which the financing is done. And so not only do we have to convert it into money, but sometimes if the financing is coming in FX and foreign currency, then we also have to think about that. That is less of an issue in Brazil today. Maybe that was an issue in the 1980s. But exchange rate stability is less of an issue now. So that's one thing to keep in mind. The other thing to keep in mind is that when you have an idea and a business, it's one thing to finance a pilot project or a small idea on a small scale, but if it's successful, to get it to scale to many communities, there is some time involved. And this is something called the venture valley of death. You may have come across it in thinking about equity financing, especially of new ventures. But there are certain obstacles to financing of new ventures. The largest of these is information asymmetry. That is, it's very difficult to know from the outside which entrepreneur has a good idea, and also which entrepreneur is going to work hard and make the changes necessary to get something to be successful. And then thirdly, and this is less difficult, which entrepreneur is fraudulent or not. It's easy to figure out if someone's likely to be fraudulent or not. But it's much harder to figure out if they have a good business idea and if they will be able to make it succeed. So that information asymmetry is a problem, and generally organizations like banks are not equipped to address that. So somebody else often has to do that. And venture capital funds can do that, but venture capital funds have a different game that they're playing. They're generally looking for ideas which will have a 10 times return. You know, they call it a 10x return. And they might be willing to invest in 5 business ideas if one of them gives a 10 times return and the other 4 go bankrupt. But if you're always looking for 10 times ideas, then you will also ignore many ideas which are not sexy, which are not going to be that 10 times idea, but which will have a lot of benefits for society. Okay? So you may have to think like a venture capitalist, but you'll have to adjust that. And often governments, multilateral agencies, the community, you can get their help, but it means that you have to bring together a lot of people. And so part of the challenge of financing is bringing together people, bringing together everyone you need. So, you know, very often people will think, I need financing for a project. What do? I go to somebody who knows about money. But it's not like that. It's more like there are dozens of different kinds of money. There is money that is there to fund something for 3 months. There's money that's there to fund something for 2 years, fund something for 10 years. There's money that wants interest rates. There's money that wants equity. There's money in between, somebody who's willing to lend you on convertible debt. So you have to understand that. So in some sense, you have to bring these people together. And very often the ventures that you are trying to fund will not be aware of the range of financing solutions. So just to give you a big picture sources of financing, there are two kinds of ways to raise funding. One is balance sheet funding, and the other is off-balance sheet funding, which we also often call risk reduction. And balance sheet funding is well known. You could raise equity, you could raise debt. A very important way in which community energy infrastructure is funded is through advance purchase revenue, either the purchase of the actual infrastructure or simply prepayments for services paid. Carbon credit sales. Brazil has a very active and large ecosystem of carbon credit developers, and that can be an important source of funding for many of these projects. And of course, grants from the state and also from foreign agencies. But risk reduction is also interesting. There might be ways, and commonly some of the examples I'll show you, you probably know that if you have a power purchase agreement from a good credit, then it becomes very easy to finance any kind of renewable energy infrastructure. And it doesn't matter if the community itself doesn't have a good ability to pay. If there is a mandate, say from the state electric supply company, to provide that energy access. So there are examples, just looking at this case in Namibia, where the government electric distribution company has a mandate to provide energy access to remote locations. And so in that context, that energy company will sign on to a PPA, a power purchase agreement, and will completely change the ability to finance. Insurance, hedging, guarantees, these are other ways of doing this. Let's look at some examples. So a few years ago in conjunction with the Banco Interamericano de Desarrollo bid, we at Columbia Climate School, we did a study of some of their examples of funding these types of projects. And there are two case studies which I think are important for this community. What was clear about those case studies is that sometimes you have to collate or curate both concessionary capital and market rate capital. So concessionary capital would be philanthropic capital, maybe providing loans at a lower interest rate, maybe long-term investments, maybe some grant involved with a focus on development. And then market rate capital is the kind of capital you're used to, which simply wants to generate the highest risk-adjusted return. And those are listed debt, listed equity, of course, bank loans, and securitized credit. And we looked at some examples, and one of the examples was an interesting one, something called the Sustainable Energy Facility, put together by the Inter-American Development Bank to help fund geothermal energy in small Caribbean islands. Okay, so if you think about small islands in the Caribbean, they have a real problem with decarbonization because they don't have a lot of land, and so it's very expensive to install solar because the underlying cost of solar is the land taken up by them. So solar is difficult. Wind is also difficult because, again, they don't have a lot of land. There are tourist locations. It doesn't look good. And offshore wind is very expensive. So geothermal made sense as a good source of renewable energy, but geothermal has the following obstacle. It's a little bit like drilling for oil, in the sense that with geothermal, you have to do exploratory drilling first, and that's expensive, and you might do exploratory drilling in 20 places before you find the right place that has this sufficient, it's not too expensive to drill deep because of the nature of the rock, and also the temperature of the water underneath is sufficiently high that the gradient between that temperature and the surface is high enough that you can extract that geothermal heat. So you have to do some of that, and it's expensive. So that in that case, IDB put together, along with some grant and guarantee funding, as well as with market rate loans from commercial banks, they put together a structure where essentially the concessionary capital would provide the funds for the exploratory drilling. And if that drilling was successful, then those funds would turn into a market rate commercial loan. Because of course, if it's successful, then we know that there'd be enough cash flow generated to pay off that loan. But if it wasn't successful, it would be turned into a grant, because these are small Caribbean islands that faced debt capacity problems. So yes, you can find concessionary capital, but the key thing is you have to put it together. It won't work if you just say, okay, let's pay somebody a grant to look for places, and then you go and you look for places. You won't have that future incentive to make it work, and so it needs to be thought through. Another example, and this is very common. This is a common structure that now IDB and other multilateral agencies use, is the A-B structure. So in general, with any kind of infrastructure project, renewable energy, the risks of the project are much higher at the pre-construction and construction stage than it is after commissioning. So once you have the plant operating, then the risks are much lower, and you will be able to get lower interest financing for it. Market rate lower interest financing when you've got an operating project. But pre-operating, when it's in construction phase, it might take a year, 18 months, 2 years, depends on permits. In that phase, you won't get any sort of reasonable interest market funding. So it won't make sense for you ever to have the same kind of financing for both phases. So you want to generally have construction financing, and for that construction financing, if you're serving low-income communities, you can find concessional rate, but it'll be short-term and will be tied to the commitment to get it to commissioning. And then once it's commissioned, you can use the issuance of market rate debt to repay that construction loan. And so this was an example project, a solar energy project. A useful resource that you may want to look at is the US Climate Finance Tracker. And this is work where they've tried to put together in one place all the transactions with concessionary capital as well as market rate capital, and show you that. So it's showing you who the funders are, what kind of capital they provided, equity, debt, what was the project they financed for, what was the term of the project, and so on. So it's a very extensive database, and it's constantly being updated. Here, for example, I just took a snapshot of mitigation projects being financed. And it's hard to see probably from this distance, but if you go to the website, you'll see that the top projects for mitigation are renewable energy infrastructure, and that's a common, easy to finance. It's an asset that's easy to finance. On the other hand, adaptation projects or resilience projects tend to be harder to finance. And there's some reasons for that. We can get into it in the questions later if you like. But the adaptation projects are more often about irrigation, sanitation and health, and increasing the adaptive capacity of low-income communities. And that tends to be fewer projects, smaller dollar amounts, a bit harder to finance historically, but hopefully that will change. It is true, as you probably know, that the vulnerability for climate-related events is mostly on the shoulders of the developing countries, while the historical cumulative responsibility for the carbon emissions is almost all on the developed world. And so there is that injustice in the vulnerability and the responsibility. And so adaptation is an important investment initiative in developing countries. Because, and I would say much more important than mitigation, because it is in many ways too late to prevent the kinds of disasters faced by the developing world. And so it's important for those countries to start assuming that we will need to adapt and to invest accordingly. Okay? The timer is saying that I have about 5 minutes, but I'll go through some examples. Here's sort of an easy example, community solar. And I'm guessing that you have something similar. Community solar is a sort of model of providing renewable energy in the US, where you have a handful of homes, shared solar, often a distributed model, so may be off the grid or may be on the grid with net metering, meaning the ability to take it off the grid or to send excess back into the grid in some situations. And often what will involve is that a community will come together and they'll make a commitment to buy from that local provider, possibly by owning the infrastructure. And it can be a very useful poll. That is the cost-benefit analysis for the user can be positive if you're worried about inflation, which has been a major concern only recently in the US. But this started probably 5-7 years ago. And at that time, many of the financiers and the users, they weren't thinking about inflation, but because of inflation, the uptake has been much greater now. So that can be an important aspect. So this is an example, and in the U.S. there's something called NREL, National Renewable Energy Laboratory, which has a lot of information, financial modeling, how to structure the capital structure of various types of energy solutions, lots of case studies, and this is one for community solar. So this one involved a slightly higher price for the electricity, 18 cents per kilowatt hour instead of the market, which is about 15 cents per kilowatt hour. But the users agreed to do that because they essentially got a fixed price for up to 30 years. And that has been a good deal for them more recently. But this, you can construct it in a certain way. This had 2-year minimum participation, an upfront fee, a membership fee, which also helped to pay for some of the costs. I think the model for this is available, so you can find more details about them. There are some. There's a range of things that help to bring that together. First of all, if it's benefiting low-income communities, there is usually some kind of government subsidy, and I know that you have that in Brazil as well. And it can come in different forms in the US, and it depends on the state, but it can come in the form of low-interest loans from the government, or it can come in the form of a government-funded prepaid subscription. So since the government has a mandate to provide electricity to rural areas, it might be cheaper for them to fund that than to actually build out grid infrastructure. You often have payment through the electricity bill. I know that you have that here in Brazil too. In many developing countries, you have prepayment or sort of payment in blocks. So you'll go and you'll use your phone to buy so many units, and then use that over a month or two, and then pay more when you need it. And so this is a way to encourage conservation while providing access as well, and also limits the likelihood of low-income users falling into debt as a result. There's something called the Community Reinvestment Act in the US that affects the banking sector. And this is because of previous legislation. Most banks have an obligation to provide access to financing for low-income homes, low-income infrastructure, and the banks are very willing to work with these community solar because it helps them meet those obligations. So that's a model where essentially you have the regulator creating an obligation for the banks, but not requiring how that obligation is met. So there are multiple ways in which it's met, and then essentially the developer community works to utilize what makes sense in various situations. Green bonds is an innovation that you've seen, I'm sure. This is a very large-scale innovation. Is not necessarily appropriate for small community infrastructure projects, except in situations when they're securitized. So in general, listed bonds, green bonds, are what we call labeled bonds, and there has been an explosion in issuance of labeled bonds, especially in Latin America, since 2020. Green bonds are a kind of labeled bonds in the sense that usually when a company issues bonds, there are very few restrictions on how the use of proceeds can be deployed. But a labeled bond, a green bond, requires that the money that's raised be used for activities which fall within what's called a green bond framework. And that framework outlines a range of activities which have broad environmental benefit. And so the issuer is restricted to using those funds for that purpose. And there's usually some tracking of the money received and the disbursements. There is something called a second opinion. That second opinion is issued by an agency, a third-party agency, like it could be Moody's, or it could be, there are a number of S&P and Sustainalytics, MSCI, some of these entities that will issue an opinion saying that the use of proceeds fall within that framework. That costs money, depending on the size. It can cost anything from $15,000 to $30,000 for one issue, but so it only makes sense for a large issue like a $30 million, $50 million issue.
So for small projects, that doesn't make sense. But what often happens, and there is, and I'll skip through some of this, what happens is that you do get a kind of pooling of projects into a single green bond framework, with the green bond being issued for a securitized pool of those assets. So that's how you can make it work for small projects, where you have underwriting guidelines that all the projects will fit certain rules, that they will lead to decarbonization, that they will impact low-income communities, that they will have some financial criterion. And so you structure that as the pool, and then you issue a green bond based on, for that pool. And that model has been utilized. This example, Neo Energia in Brazil, this is not for a pool as such, it's for one issuer for its own projects. But you can, one easy way to figure out how these are issued is to go and look at the second opinion, it's public, and to look at the framework that's outlined and understand how you would structure or adapt that framework for your own project. Another example is something called a sustainability-linked bond. This doesn't restrict the use of proceeds. There are many, especially sovereign issuers who are in a situation where they have already, in some sense, decarbonized. This is an example of a sovereign debt issuance by Uruguay. Walter was also somewhat involved with this. And Uruguay has a 95-98% renewable energy in its electricity mix. So there wasn't a lot of green investment that it could do. So it couldn't really issue a green bond because it would have to use those proceeds to invest in infrastructure, renewable energy infrastructure, which didn't make any sense when it was already at 98%. But so that's why they issued what's called a sustainability-linked bond, where the proceeds can be used for anything, and in this case, it will be used by the government for a range of purposes. However, they commit to meeting two sustainability targets, and if they exceed those targets, then the interest rate will fall. So it's an interesting bond in the sense that it's structured so that if they fail to meet the two targets, then the interest rate will rise, and if they meet the target and they just meet it, then there'll be no change. But if they go beyond the target, they decarbonize by more, and also they increase the amount of native forest cover, then the interest rate will fall. And that's a useful incentive for the government and various ministries to work towards those goals. So there's some details on that, which I'll skip in the interest of this. I want to talk to you, we're sort of running out of time, so two things. One is an innovation from the US called a Community Development Financial Institution. This I've not seen in other countries, CDFIs. And they arise from the following problem. See, banks have a lot of capital that they want to deploy, and they have access to low-cost capital because banks can easily generate credit. However, they face the problem of having to do due diligence on the borrowers, and when there are many borrowers and each individual borrowing is small, then it's not worth it for the bank to evaluate each of those borrowers, because the amount of, so if you think about a small loan, a $10,000 loan, if it pays 10% interest over 3 years, it will generate $3,000 in interest over the lifetime of its loan. For a bank loan officer, it's not going to be worth it for that bank loan officer to spend a lot of time evaluating whether this credit will be good or not. Because if he's successful, then he'll earn $3,000, and if he fails, he'll lose $10,000. So the incentives are all wrong. If he works hard and gets it right, he only earns $3,000. And if he makes a small mistake, he loses $10,000. So that's why they will avoid this sector unless they have good information. They're not going to get information unless they're part of that market. So they typically need to partner with other institutions, and the community development financial institution is usually an institution that's grounded in a local community. And they have other things. We call them place-based institutions. They might be associated with a religious organization, a church. They might be associated with a particular trade, say truckers, let's say. Where there is a lot of information about the potential borrowers that's easily being generated. An example of this is not called CDFI in Mexico that I've seen, is a fintech company called Konfio, Konfio, and they work in this way. They basically have partnerships with banks which provide them with easy, low-cost capital, but they actually work to find those small business borrowers, and they have information from the payment histories of those borrowers that they can leverage to generate that. So that's an interesting example, and there are versions of that. BNDES has a credit fund for SMEs that operates in the same way, and they utilize the transaction data of those SMEs as a way to guess the borrowing capacity. And that information can be really helpful after natural disasters. One of the things to understand is that if you have a natural disaster in an area and that affects the economy of that area, and you say, okay, well, I need to know who was vulnerable, whose home got wiped out, and I want to send money to that person. Well, it's going to take you 2 years to figure out who that person is and how much they lost. And in those 2 years, the economy will stagnate and collapse. So the priority is to try to get disbursement out quickly, and often you won't have the time to work out who got hurt. So if you can identify the SMEs in that area, it doesn't matter if that SME itself was not hurt, was hurt, if its neighbors were hurt, you see, because the SMEs, when they receive financing, they don't take the money and send it to Switzerland or Cayman Islands. They spend the money in the local community. So therefore, that spending will most likely help the neighbors. And you don't know which neighbor got hurt, but you know that SME is there. So that can be a good way of post-disaster financing. And so this is the BNDES example. They also have this, emergencia fund, but this emergencia fund tries to establish who needs the money, and that's useful too, but it can take too long, and that's a problem with that situation. So the timer is saying 00. So I'm going to just skip these and just talk to you about one last example, which is mostly I've talked to you about debt disbursement or fixed income disbursement, but it's also important to pay attention to equity investors. You probably have heard the name of Amaz, and this is a venture capital fund, and they have had some significant successes investing in products of the Amazon bioeconomy. And their aim is to work towards, of course, the large companies like, say, Natura, which is focused on the Amazon bioeconomy, but this is focused on venture capital for small enterprises that can be scaled up. So that kind of equity investment is also important. You know, the way that vulnerable communities can be resilient, one is through investments in energy, two is through investments in water and coastal protection, but three, and very important three, is by increasing their level of income and their integration into the economy. And so that's where this type of venture capital investment is very important. So I'll stop there.